where it gets serious. If an NBFI, say a major private credit fund, suddenly can't roll its debt, it may be forced to dump assets at fire sale prices. Those assets, often corporate loans or structured notes, are held by banks as collateral. When prices plunge, collateral values fall, forcing banks to take losses or call in other loans. That's contagion. This is not theoretical. During March 2020, money market funds froze, forcing the Fed to launch emergency facilities. In 2022, the UK pension crisis nearly toppled gilt markets when leverage in LDI funds backfired. And in 2025, we're seeing smaller versions of that same movie playing out through trickle-down-like collapses in private credit. Regulators call this liquidity mismatch, borrowing short, lending long, with no backstop. Banks can turn to the Fed in a crisis. Non-banks can't. So when panic hits, they sell, and prices spiral. Even if only a handful default, the signal to investors is clear. The illusion of safety is gone. And since NBFIs now intermediate more credit than banks, the consequences ripple across the entire economy. Higher spreads, tighter lending, slower growth. A credit crunch, born not inside the banking system, but just outside its perimeter.